Do you want your business to grow faster? Are you open to new and out-of-the-box ways to drive revenues and increase value? How do you imagine the most successful entrepreneurs and business leaders double, triple, or expand their businesses tenfold or more? The answer is deals. This is a weekly podcast featuring conversations with business owners, executives, and leaders as we reveal behind-the-scenes details that give you, our listeners, the confidence to pursue your own deal-driven growth. On this show, we discuss a huge variety of deals, everything from large, complex mergers and acquisitions, capital raising, joint ventures, strategic alliances, real estate, affiliate and sponsorship deals, franchising, and more. My name is Corey Kupfer, and I've been supporting deal-driven growth for businesses for over 35 years as a successful entrepreneur, professional negotiator, and attorney. My goal is to help you strategize, plan for, find, and complete deals that will help your company grow faster. Welcome to the DealQuest podcast. Let's get started. Hello, DealQuest community. This is another solo cast, and we're going to be focusing on what will seem like a specific topic in a specific industry on this one. But I would encourage everybody to listen because it applies in other industries, some of the concepts and who is appropriate investors at various stages of maturation and growth in an industry. Those concepts apply across industries. Specifically here, I'm going to be talking about sovereign wealth funds and their investment in the investment advisor space. Many of you know we do deals across industries. You name industry, we've done a deal in it, but we have this niche in the investment advisor space and the independent RA space, and we do a huge number of deals, both on the sell and the buy side. And we've talked about the maturation of this industry certainly over the last 15 years. We've been doing stuff in it for 25, but really the independent advisor movement the last 15 years, and then certainly the advent of M&A, and then especially in the last 5+ years, the PE money that's come into the space and all the aggregators and integrators and serial acquirers, many of them, most of them backed by PE money. And so let's talk about generally the evolution of industries that apply across. It certainly applies here, right? So, what happens is you have a new space, the independent RA space being an example. In the beginning, of course, there's just, early stage startups in the RA space, breakaways out of wirehouses, banks, trust companies, or just people starting up new firms in other industries. It could be any kind of, startup environment. And there's a period of time where those firms are just getting established. Those companies are growing. They're proving out models. They're proving that it works. They're getting sustainability. They're growing organically. And then what happens next? Well, over time, then they started looking at inorganic growth, and maybe there's small tuck-ins and, adding other small firms, advisory firms, other firms in other industries doing it as well. And then there starts to be bigger deals that happen, right? Because more financing comes into place. For example, in the RA space, I go back 15 years, there was barely even lending capital. Forget equity investment capital. It was hard to finance deals. Then lending came in, then, investors came in, and then PE came in, minority investors, all this kind of stuff. Capital became more abundant. So then more deals happening. And then, when the PE money comes in, now you get some volume of deals, and you get the aggregators, integrators, serial acquirers who start doing deals in volume, the WEGs, the Mercers, the Hightowers, the Cerities, I can go on and on and on, right? There's, good 20, 25 firms now that are doing a lot of deals between, 5 to 8 deals up to 20 something deals a year. Now, what happens in that natural maturation cycle? Well, there's a need for not only growth and additional capital, but how do founders, how do investors at the various levels get to exit, get to monetize? So, what inevitably happens is that once we get to the stage where people have moved from self-funding deals and or funding it from lending capital to maybe taking minority investments or PE money or family office money, the initial, let's talk about the PE track, for example. The initial, PE firms tend to be the smaller firms, right? Because these newer aggregators, integrators, and serial acquirers are folks that are not as big as they become, right? And there are earlier stage, smaller stage investors that come in at that stage. And then at some point, they, because when you're talking about PE money especially, they have a time horizon, right? They've raised the fund. It's other people's money, people looking for a return, right? A lot of times it's 3 to 5 years, 7 years, at most. Maybe their entire fund runs 7 to 10 years, and they need to monetize and show returns to their investors to be able to raise additional funds, make additional investments, et cetera. So inevitably, you end up in this sort of ladder of, well, okay, now we have a bigger PE firm that invests in bigger size deals, and they may help get a return and exit out, maybe to the founders taking some money off the table, maybe to the earlier investors, the smaller PE firms. And you go up, a ladder of professional investors, of PE firms, that you may have two, three, four different levels of that. And then the question is, now what? Right? That's the key thing. Now what? Right? What do we do? Well, there's a few options. One is, in a worst case scenario, you run out of options, right? You have an investor that wants to be able to exit. You do not have any other investors, whether in the public or private markets. So we'll talk about the public markets in a second. And now either your investor is stuck, or they're going to force, if they have these rights, and they might very well, depending on what their agreements say, how much board control they have. Maybe they have triggers specifically in the agreement that if you can't, help them monetize, they can either force a sale of the firm or put their equity back, which would essentially, if you can't raise additional capital to take them out, there are certain consequences of the inability to exercise on those puts. And what happens is that in a worst case scenario, you have a situation like, for example, United Capital, when they sold to Goldman Sachs, right? Because the PE people wanted out, at least, there were other reasons given, but a lot of people behind the scenes think this was the biggest driver. And in that case, the Goldman Sachs sale didn't work out very well, right? They ended up flipping it some years later to creative planning. And, people in the industry sort of know that journey, but it's symptomatic. So I won't spend a lot of time on that specifically, but it's sort of symptomatic of this thing that happens where you keep getting bigger investors to take out the prior investor, and then you have to be able to keep going somewhere, or else there could be negative consequences to it. So what's this, what's the latest thing that I want to talk about is these sovereign wealth funds. It's something we've seen over the last years. It's been reported a little bit in various of the press. I mean, you saw some articles, those who pay attention, in CityWire and, wealthmanagement.com and some of the other ones over the time. But, to call it a trend, I don't know. There've been a few deals. Maybe it's the start of a trend. It's certainly logical that there's going to be more of this. Why is that? Because we have bigger players now that have gone up that ladder, or they've grown. I mean, Fisher Investments, I'm going to talk about in a moment, is a firm that grew, very big, initially largely organically. I mean, they did a phenomenal job growing organically before they even started growing inorganically through deals. And the combination of those, make them a very big firm that has the amount of investment necessary to come in to be meaningful, eliminate a lot of the smaller players in the deal. So what do you have left? Once you sort of work your way up the PE ladder, well, you can either go public, which is something that is definitely a possibility and that happens in various industries successfully. And certainly, for example, in the tech space, that's something that is, I was going to say, a usual thing. The truth is that the far majority of companies don't go public, but it is a much more well-worn path of high-tech companies going that way. Although, many of those who think they can IPO end up getting acquired or failing. But certainly there's a lot of examples of companies that have IPO'd in tech and other spaces successfully. But, in the wealth management space, where I'm about to talk about the sovereign wealth funds, frankly, it has not been shown. It'll get there. There's no question at some point. I think there'll be a more robust public markets. But if you look at it, all right, a couple of the companies that have gone or have talked about going public, it hasn't worked out. I mean, Focus Financial went public, was taken private subsequently several years later. So, the public markets didn't really work out for them at that point. There are other firms interrelated to the industry. Dynasty was looking to go public, right, but pulled a public offering when market conditions weren't, ideal. Obviously, they're a little different firm than an RIA aggregator, but there's somebody in this space. And then you have, other folks where there were talks. I mean, one of the firms I'm going to talk about in terms of sovereign wealth investment is CI Investment Corient. And CI was talking about, CI is the parent, the Canadian parent of Corient, which is a company that's been doing a lot of acquisitions in the U.S. in the RIA space. And, there was talks about CI taking Corient public as a monetization strategy for that U.S., RIA, and that has not happened. And so there has not yet been a proven track to go public in the RIA space. So why are these sovereign wealth funds coming in? Well, first of all, they have the muscle, they have the money, they have the ability to buy into these biggest firms at the highest level. If you look at these sovereign wealth funds, I mean, the size of these things, around the world are huge. So the amount of money that needs to be invested, which is very, very high comparatively for the types of PE investors that are in the RIA space, is not very high in the scope of the assets under management or control that these sovereign wealth funds have and the other types of investments they make in other space. And all the reasons why the PE and minority investor and family office folks are interested in the RIA space are all the reasons why it's also a good investment for sovereign wealth funds in that there's, recurring revenue, right? That's reliable. I mean, obviously it's affected by the market, whatever, but it's recurring revenue paid in advance on assets under management with folks that have a lot of incentive, right, to run a good firm and be successful because their reputations are on the line and they help other people, manage money. And also it's the kind of thing, most sovereign wealth funds have a long-term outlook, right? So they're actually, from their point of view, having this recurring revenue model that they can hold for as long as they want and be positive. Unlike, for example, investing in a tech company that does not have revenue or profit and you're betting on the arbitrage play when you go public, these are good cash flowing businesses, right? Obviously, you can also exit them at some point, but you can hold them. And from the point of view of the firms, it also gives them, meaning the RA firms, the bigger firms that are taking in these sovereign wealth investments, it gives them a long-term thinking partner and takes some pressure off them, to be able to flip PE firms as their funds are running out or as they have to show returns to their fund investors, right? Sovereign wealth funds don't have the same kind of pressures and they have a longer term outlook. So let's look at a few of the deals that have been done in this last year, less than a year, really. I mean, so the earliest one out of the three that I'm going to talk about that I'm aware of is Mercer. And it's funny, this didn't get a lot of fanfare when it happened. But in June of last year, Mercer, which was about 70 billion at that time, took in an investment from GIC, which is a Singapore wealth fund. And, that Mercer is the smallest of the three deals we're talking about. But that's a significant investment that they took in from a Singapore wealth fund. It's put Mercer in a position to continue to grow and do additional deals. So that was the first one. The next one that I'm aware of is, I mentioned CI Financial, which is the parent company of Corient. So CI Financial is a public company in Canada, traded on the Canadian exchange. They have a subsidiary, Corient, and Corient's done it. So we've done a lot of deals for clients, number of deals selling to Corient. And the interesting part about it is that CI Financial had previously done a sale of 20% of Corient, its subsidiary, to Bain Capital and the Abu Dhabi Investment Authority. So, it already has a foreign fund in the Abu Dhabi Investment Authority as an ownership piece in the selling 20% to them in Bain in Corient. Well, this was at the CI level that happened it was announced in November of this past year, 24, where it was taken private off of the Canadian Stock Exchange through funds managed by Mubadala, which is an Abu Dhabi sovereign wealth fund. And they took the company private, CI. So Corient has about 130 billion. And that was a $3.4 billion deal with a $12.1 billion valuation. So, if you look at this, these are multi-billion dollar investments, right? There's only so many, types of entities that can do that. But Mubadala, has a 1.5 trillion, that's with a T, trillion in assets. So for them to invest a few $1 billion is not a significant part of their portfolio, unlike even some of the larger US PE funds. So that was an interesting deal. So they took the parent company, CI Financial, private, which of course, part of a chunk of what they own is their subsidiary Corient in the US, effectively having an indirect investment by Mubadala out of Abu Dhabi, while also having the Abu Dhabi Investment Authority, having previously invested a different Abu Dhabi entity fund invested in the subsidiary Corient. The latest one that's come up is Fisher Investments, as I alluded to earlier, which had great organic growth and then has done a lot of acquisitions. And they took a $3 billion investment from the Abu Dhabi Investment Authority, along with Advent International, at about a $12.75 billion valuation. And they have about 275 billion under management. So, so you're talking about, valuations on two of these deals that are reported. I don't have the Mercer valuation deal handy, but, that are in excess of $12 billion. And, so part of the question is, hey, is this a few examples or is this a trend? And I would certainly, listen, nobody can predict the future, et cetera, but I would certainly expect to see more of these types of deals because we're in this stage now where there's a lot of the bigger players And there's only a few options, right? We talked about IPO. The IPO market's not ripe yet, really. I mean, it'll get there, but I think we got a couple of years before you're going to see any kind of, and then also that depends upon the stock market staying strong. Obviously, if we end up with a dip, or negative time in the stock market, it'll slow things down in terms of these valuations, and firms will probably want to wait a little bit, even if there's a thinking of IPOs. So what are you going to do if you're not going to IPO? Well, you really come down to, I think, two options. You're either taking investments from these bigger players like the sovereign wealth funds, or maybe the big other institutional type of domestic investors. But again, I mean, it's hard to compete with the amount of money these sovereign wealth funds have. Or, you're trying to do a merger of equals, or if it's not equals, like a aggregator to aggregator merger or combination. And those are tougher in a way in that, you've got two different operating firms, two different CEOs, management teams, systems, approaches, et cetera. I think that will happen as well. There's no question that there will be an aggregation of the aggregators, but it's probably more palatable for a lot of these aggregators, integrators, serial acquirers at this point to take investment capital in where they can, because there's still a lot of growth upside, where they can continue to grow under their existing model with their vision, values, and existing executive team. And not, do the merger of acquirers yet. So, I think it's an interesting trend. I think it is something, again, that's not unique to the investment advisor space, but it's something that you see at this sort of equivalent level of maturation in various industries in the past. I think it's, again, going to continue. I think it's interesting to look at these and, that strategic decision, right, to take that kind of investment from those kind of funds. And, usually not a lot of information out there on how these deals are structured. And even to the extent we've been involved in some of these kinds of deals in the past, we couldn't disclose anything specific. But, you do generally have more patient capital, even if they may have rights, if there are triggers that cause them problems. But you generally have more patient capital. You have the ability to invest. And, it gives these firms a lot of runways. I mean, if you look at CI Corient, Mercer, and Fisher Investments, they're looking to continue to grow and acquire significantly, and they have the funding to do so. And it does take some pressure off on having to look for another capital partner to take out the prior capital partner. So it'll be interesting to see what happens in 2025 and whether there will be more sovereign wealth fund deals or whether we will get to an IPO market in the space. I doubt it this year, but who knows? I could be wrong. Or whether there will be any big aggregator combinations, which I also think probably we have a little time on, but we'll see. So let's monitor it. Let's check it out. Definitely worth, if you haven't looked at some of the reporting on these deals, definitely worth checking it out, get a feel. And, there are many other of these large firms out there that, may very well go this route as well. So that's it for this solocast. Definitely looking forward to the next 3 weeks of interviews, and then I'll be back with another solocast in 4 weeks. Take care, folks. Thank you for joining me on this episode of DealQuest, where we help you understand how deal-driven growth can be your ticket to freedom. If you are interested in finding out more about my law firm, the services we provide to entrepreneurial and growing companies across industries all over the country, and my partner Brian Megan and I, and my amazing team, just head over to kupferlaw.com. That's kupferlaw.com. And if you want to follow more of my content, head over to my LinkedIn page where I post regularly. I'm Corey Kupfer. Until next week, wishing you the freedom and financial prosperity that I know your DealQuest will bring.